Okay, so we're now going to move on to gaps. Now, a gap as a pattern, I guess, isn't something that you can necessarily see forming. Unlike a head and shoulders or flag or anything like that, where the pattern forms, you can then plan out what you're going to do as that breaks, how you expect it to move, etc., as we've already discussed. With a gap, you don't know it's coming until it's a gap. So it's more about having a process by which you can define what type of gap it is and how you're going to play it, rather than being able to predict a gap. I think the reaction to a gap can be predictable, and the element of a gap can be predictable in the sense that you can predict what will cause a gap, but you can't predict when that will happen. So what essentially is a gap? The reason that you get a gap is that perspective changes. Now, this is typically the case of additional information. So this will be where a market is closed, and you get more information that comes in whilst the market is closed that forces people to reassess where the market is going to reopen the next day. Now, the way that this happens is each time the market opens, you have an opening auction. And I'll give you an example of this when we look at crisis trade, and we'll look at Sunday night gaps and how you can play Sunday night gaps. But essentially what happens is every morning when a market reopens, people put in all of their orders for the opening price, and the opening price is determined by aggregating those orders. So if your market's trading, let's say $50, and the next day there's been new information that suggests the market should be trading higher, what happens is people who want to buy may well bid $60 to say that they're willing to pay $60 at the open the next day. The opening price will be the point where there's enough sellers to match buyers. So the price may have to actually rise in order to find enough people willing to sell to match buyers, in which case the market may well open at 61. So that's how you create this gap. It's the aggregation of orders that opens that is what dictates that opening price. And we can perhaps discuss this in a little bit more detail. I'll sort of draw you an example later on if people do have questions on that. So it's all about changing perspective. Typically, a gap's going to be created by a piece of news. And what this will do is then drive the market away from where it currently is, because that information needs to be priced in. And so as a result, in the short term, you should assume that any gap is likely to continue in the direction of the gap until the gap closes. Now, I know that that's quite a vague term, because you can always argue, well, it will keep on going until it doesn't, which is obvious. But what I mean is you can look for continuation trade. Let's say it's a gap up, continuation up, until you get to a point where the gap closes. And once it's closed, still the move is biased to the upside. It's only when you move inside the range of the previous day that was where the gap was from that you can now say, okay, this gap is not held. Generally as well, gaps do fill back eventually. And that's, again, a slightly generalized term. And so I don't think this is something that you should use to try and generate any kind of strategy, but any gap that is created does generally fill back, and it's a sign of a stronger market. The market that moves up and gaps higher generally will then pull back at some point to see if there are buyers in that gap, essentially. If the market runs out of buyers at higher prices, it will fall until it finds buyers. The gaps are often the points where you will find buyers, and a good, strong market will typically come back and fill gaps. You also need to consider the element of a price versus a close gap. So there's two situations here. A price gap is a gap where a market trades in a range today, and then the next day, gaps above that. There is a distinct gap. If you put the two daily candles together, there is a gap between the high of one and the low of the other. A close gap can happen day to day within a range, whereby you have a market that trades in a small range. So if I draw it here, you get a market that trades like that and closes here. And then the next day we open here. It's still within the range of this day, but there is a gap to the close. Now, typically, this is something that you would expect to close. There's a very high probability, and I will give you the stats on this when we move on to profile week, that opens inside range will fill gaps, and there's a pretty high probability of this happening. Because essentially, nothing's really changed. It may just be a bit of early positioning. People who've got orders that need filling, that they get those orders done at the open, and that's what creates that slight deviation in price from the previous day's close. So think about things in terms of price gap, close gap. Equally as well, and I'll try and give you an example of this, you can have a situation where if you've got, say, a market that's moved up again like this, we close here, there's your high, so you have a high and you have a close. The next day we open higher and trade up a bit. That's an area of support, as is that. A bit like the kind of high, secondary high reference. And until you get through the close, equally, this could maintain the bias towards the upside. Right, we're going to look at different types of gaps. First up, we're going to look at what I call a breakaway, liquidation, initiation type gap. This is the first instance of a gap. So where you have a market trading in a range, for example, you have a market trading in a clear trend direction, and the market then gaps backwards against that. Different types of gap, and I'll give you illustrations of each of those in a moment. This essentially is the start of a new move. Now, it could be a new move formed by old participants getting driven out of trades they're already in. It could be a new move by initiation or breakaway gap, as these two kind of go together, where you have a directional move already, and the market then gaps beyond that. So it kind of accelerates that move in or whilst the market's closed, creating this gap above. Often you can get a gap created by correlation to other market. So for example, you could have a gap in the European session created because the US markets finish strong, followed by continuation of upside movement in Asian markets, which then creates this correlated gap higher in European markets, for example. We'll look at an exhaustion gap. Now, an exhaustion gap is a slightly harder thing to define because with an exhaustion gap, you don't know it's exhausted until that gap fills and then starts on another leg down. But typically an exhaustion gap is going to follow a breakaway gap. So you get a breakaway, move continues on, and the exhaustion is an indication that people are now so urgent to buy, if you want to move up, for example, that they're willing to still pay significantly higher than the previous day's close, even on the back of a clear directional move in one way. That's generally the indication of an exhaustion gap and can be the first kind of indication that a directional move is perhaps starting to come towards an end. And then we're going to look at reversal gaps. So what you call an island reversal. This has similarity to a liquidation gap, but essentially you get a move that traps the position, so you get this very clear direction as the market, let's say, drops, gaps down, so it shows strength to the downside. People then position and then it gaps back up on them, leaving them essentially trapped on an island. This then creates a very strong counter trend move because of the fact that people have been left behind. Everybody on that island is offside and there's no way that they can't be. That's what then creates the move towards the upside. One final caveat on a gap, and this is a generalization, but particularly gaps created on news. What these will often cause is a very explosive open, followed then by a typically non-directional day. It doesn't mean it won't be volatile or won't have a decent sized range, but it's often non-directional. And the reason for this is that once the market gaps, you now have a situation where people need to reassess. If you've been looking to buy and all of a sudden the price has jumped much higher, are you still willing to buy? You're not likely to be so urgent to buy and more inclined to wait for the price to fall back before buying. So therefore there is a hesitancy from buyers. Equally, there's a hesitancy from sellers because if you have news that has driven the price higher, they could well be selling in front of a much larger continuation move. And again, that's going to result in hesitancy from sellers who are perhaps going to wait for higher prices to try and sell into as the move slows down rather than push the market back down. It's a hard thing to see a market gap up, move up, and then see that that's a good reason to go straight the way back down. So you get this hesitancy from both sides because the market's moved to a completely different area. And so there's then this element of having to kind of feel out where the next stage of any movement comes from. Right, so let's go and have a little look at identification of breakaway and exhaustion gaps. I also illustrate the idea of a gap that's a price gap and a non-price gap. So this structure here, this is an hourly chart and it's of this small phase on a daily. Essentially, a failure to break range to the downside followed by a directional change towards the upside. Now, what we have here is not dissimilar to what we have here. You have the failure down, which is this candle here, so big tail down, failure. You get the gap up, that's your breakaway gap. That's the point that says, yes, this is now a change of perspective. People want to buy this and they're willing to pay higher prices. There's urgency to buy here. So this creates a gap up. Now you get the continuation. Buying often will come straight from the open on a gap as well, which is also something to consider. And when you see these gaps, there is some value in going straight for it off the open because people who need to buy, the best chance they're going to get to buy on a gap is straight away. Because if it does progress up, because other people are also thinking the same thing, their buy price is getting worse and worse. So often you get people come straight in and you often get this quick move straight off the open. So you get this first move up. You then get another gap, but this is just purely a close gap. We open within the range of the previous day, but same again. Buyers are so keen to buy, they drive it straight through the previous high, fast continuation, and then steadying up of movement. And then you get the exhaustion gap, which is this little move here. What's happened here? It doesn't look from a chart like very much, but looking at the first hour, remember this is a red candle, so we open up here, clear gap above the previous high and the previous close. That's your exhaustion. Now you don't know that's an exhaustion in the first instance, but what we then get is the inability to continue. You look at this gap and this gap, open, straight up, open, straight up. Here, open, flick up, straight down, and a very stable day's trading. This is showing the end of movement. This is showing that lack of drive of people rushing to buy. And so it's an indication that the move is stalling, that we perhaps don't have a great deal more in this. And as such, once this gap fills and starts to trade back inside this range just here, that's then what opens up the reversal. And like I was saying about gaps closing back, once this gap closes down to that previous close, now you start to find a bit of support, which is what happens here, and then a next leg up. And that's what provides you the ability to keep going, because you come back, test the gap, find that there are buyers down here. You get these wicks on candles just down here, showing that buyers are willing to push it back off this reference gap, and then you get the next leg towards the upside. So that's kind of a brief sort of explanation of and identification of different types of gap. An exhaustion gap, you cannot be sure is an exhaustion until you see a lack of continuation. So it's more about, again, how do you play these? It's not about guessing this is an exhaustion gap. It's about understanding that once this gap is filled and we start to trade back inside this range, those who have been following this up are now being shown that this move's over. So if you want to sell, people who are looking at this as a sell opportunity are now thinking, right, we've moved higher and now you're not getting the progression from buyers. You're not getting new buyers coming in. As a result, now you can sell it. Now you can start looking for this to roll back to the downside. And that's the distinct difference, and that's what allows this move. Otherwise, you end up with a situation where you can have breakaway gap, breakaway gap, breakaway gap until you get to a point where it then starts to roll over. You look here, you could argue that this is the exhaustion gap, but on the day, it puts in a very strong move up. And realistically, that's your exhaustion gap, because we open gap up and turn straight back. That's the point where the turn really is. So there you have breakaway gap, exhaustion gap. Okay, so we talked about sort of breakaway exhaustion gaps. We want to look now at them in terms of specifics and trying to differentiate between what's happening in each. So the way I kind of try and term this is the difference between what I call a liquidation and an initiation gap. And the difference in basic terms is a liquidation is a counter trend gap and an initiation gap is a with trend gap. I'll use a basic example here of a market in a range. That what ends up happening after a move higher, market balances, builds up energy for continuation. People get themselves positioned in here. Generally, you would assume long. You've had a move up, anybody short is now feeling that this isn't the time to be short and perhaps pushed out. Sellers are going to come in, new sellers are going to come in up here. Equally though, buyers are quite able to stay in and add here. So balance is tipped towards people being long. There's a simple inference on a pattern like this. So you've got positioning built up. Now, you can have a situation where we gap out of the range, and that puts that positioning under pressure. If you gap to the upside, what happens is anybody who's been buying in here, looking for continuation, is forced now to make a decision. Do they still buy more because perhaps they haven't built up the position they wanted? Do they buy more now because if they don't, they may not get a better chance? Or do they wait and see? Because if price moves higher, this now maybe will now force them to pay even higher prices. So you have a situation where people looking for the opportunity to play the breakout don't get that chance. Not everybody is sitting here long waiting. Some people are going to be sitting here waiting to buy it on the break of the range. They don't get that chance. These more reactive traders, more aggressive traders, and they're going to look at this and think, well, I'm going to have to buy it here at the open. And this is what creates that fast rip to the upside. People get themselves trapped, or they get themselves in a situation, even where they're not trapped, where they missed the boat. And if they don't jump on now, this could be way, way, way away from them before they get the chance to get in. And so the opportunity's gone. And this is what creates that initiation gap, that people then feel they have to get in and creates this quick move up. Conversely, the gap to the downside, for all of these people who've been buying in here, and think, the implication of this move is more likely more longs in here. It's gapped over their stops. Chances are they've all got stops in here. And when it gaps over their stops, they now have to exit. And either their stop will be triggered at the open and instantly exit for them, or they will now have to get out. And all the while, their profit is being eaten into. So they're chasing to profit take here, which again creates this quick early move, typically then followed by this sort of slower participation. But that's what I'm talking about with these sort of liquidation and initiation gaps. People's ability to do something has been taken away by the gap. And so then they have a choice. At the open, they need to make a decision of whether they think they're going to get a better opportunity to buy or sell than where it currently is trading. Because if they don't think they have got a better opportunity, they will act immediately at the open. Let's go have a little look then. This is a S&P one. And this is the kind of gap that is predictable in nature of what could happen. It's not predictable in when. So what we've got here, this is the wider time frame chart followed by the shorter time frame up here. And what we've got here then is a market that moves higher. This is the 24-hour and this is your just main cash session. So this is the US session, New York Stock Exchange, 2:30 to 9 o'clock UK time. Whereas this is the full session. And so this is why you get a gap, and this is significant. Most gaps nowadays come on main cash sessions because of the fact that markets trade 24 hours. But still, the main cash session does still have gaps in it. So what's going on here then? And you can see this coming. You're looking at this thinking, right, well, we've moved higher and we're now positioning, building sideways. You've had one gap up that completely fails to keep the move going. We've then traded out the range again and we get a gap down. So twice we've been shown this market really doesn't feel comfortable going to the upside. Buyers though, in here, have not been put under any pressure. The market's never pushed back below this 67 level. And as such, if it does, that's where the pressure comes. That's where they're all trapped. And this moves you back into this essentially kind of empty space zone down here. So as a result, come the next day's cash session, we gap down and you do get, and this again, looking at the reality of what happens, you do get this spike back up at the open. Now, for anybody who's thinking they need to sell to get out of a long, or anybody who's wanting to sell because they're thinking this is a lot of a sort of a high that's not really going anywhere and it's struggling and wanting to sell the break of these poor lows for the move down, has to do it now. And this is why when you get this ping back, you get the price gap close, market trade 67. If you want to sell, this might be the best chance you're going to get. And so then you immediately run into this selling pressure, which drives the market back down. And that's what happens here. It's flick up, sellers come in there, and then as soon as you move through the open, then you get the acceleration down. That's what I mean by liquidation gap. It's people getting themselves long, getting nothing for it. And like I said with previous patterns, the longer we sit up here and people position and get nothing, the more and more inclined they are to get out. Because there's continually being given this feedback that the market doesn't want to keep on going. The market's not doing the move that they're looking for. And as such, they become more and more inclined to exit if they're shown that the market's not going. Because what they don't want to do is sit there for a long, long period of time, get nothing for it, and then have to take a loss. As such, when you get the gap, that's where they all liquidate, because if they don't get out now, it could be much lower. And in the end, it does turn into a move that goes much, much, much lower. So that's the idea behind a liquidation gap. Think about how people have got themselves positioned. It doesn't mean you can predict the day that this will happen, but you can have a really strong idea of what's going to happen here. That this is going to force people out, and it means that you've got two options to sell. On the gap straight away, or you can be very confident of selling the gap fill because of the positioning that is there beforehand. Move the wrong way. Okay, this is one, again, which I'll show you as an initiation gap, one that comes on the back of, rather than a reversal of positioning, like in the S&P one, a continuation of movement. We've got a steady move up, or reasonably strong move up, kind of flag situation, range situation here. Now, there's going to be a lot of participants quite happily sitting in here long, looking for continuation. There's equally going to be a lot of participants thinking, brilliant, we're going to buy the break of the flag and now you can go through the high, high, high continuation. So there's this pent up demand essentially, both from already long participants looking to add on as the market continues, people who are not in looking to add on the technical breakout type trade. And as a result, when you get the gap up, it's not a gigantic gap. You know, this is a DAX, this is giving you a 70-tick gap up. People come in and buy it straight off the open. There's very little hesitancy. This is it then on a 1 minute chart. And you get this immediate action, first minute candle, straight up, and then continuation. This is why you have to look at some of these trades, and there's an element of being willing to say, right, I'm going to buy it straight on the open, on the basis that people are going to initiate to the upside. And so if you buy it on the open, your expectation is you're going to go straight on side. If you don't, that essentially becomes your stop. If the market goes against you a bit, you have to say, right, this isn't working, I'm getting out of this trade. And as such, you take your loss. With this one, you do get this marginal additional opportunity because we open just about inside range. So it's a gap over the previous day's range, which is there, but not quite fully outside the range. But as a result, you're going to get people coming in, the bottom of the range comes in at 91, which is around about here. So you get about 3 ticks, maybe 5 ticks to confirm this move. If you buy at the open, it quickly jumps above that level, the move is on, and you can have a huge amount of confidence then that this is going to run for you. And very quickly, your stop can go through below the open, giving you a very low risk trade because your stop is essentially your entry point, or it's 1-2 ticks below your entry point, with the expectation now that this should run, and it should run quickly towards the upside as people chase to get into the trade. And this gives you a very, very fast 50 tick move up in under 10 minutes. And that sets the tone then for continuation. Like I said though, gaps don't necessarily continue in a large directional move, particularly the initiation gaps, because everyone who wanted to buy down here, if they don't come in and buy straight away on the open, the market's now run away from them. How much more do they want to buy now? And this is where you get that hesitancy and where you get this slower move for the rest of the day. Yes, we do get continuation, and this is still within the first couple of hours, so this is only looking at this bit of the move just here. You do get continuation, but this runs out because of the fact that buyers are going to sort of be hesitant and questioning, do they still really need to buy at these prices? And the answer is probably no. They're going to wait, and this is why you do then struggle after that first initial move to actually keep going. Very similar pattern in terms of the early action here. And this is looking again at the DAX, but this is in fact a liquidation gap. So to break this down, this is the Omicron related sell-off. Creates a gap down. As that story really breaks, you start hearing that cases are beginning to spread from South Africa around the world, and this gives you a very significant gap down. There's your breakaway gap. So continuation down, we then end up with this sort of pennant formation. As the story kind of develops, people want to know more. So the first part of this, the first move down, is a pricing in of uncertainty. We don't know what this means, is what's happening to start with. Followed then by people holding positions. Why would you get out? If this turns into something more, you don't necessarily want to be out of your shorts. Remember what happened in March 2020, how far this went. So people hold on. But this positioning comes stale. Over the course of a week or so, nothing really happens. The market sits reasonably stable in this same range. So you've now got people progressively building up positions. If this breaks to the upside, these people in here short are going to have to liquidate. Likewise, if this breaks to the downside, you would get an initiation as people continue to come in and sell. And it's the same principle. This open straight up, never gets back through the open, and then you get a second leg as well. Remember this on a 5 minute, when the cash session comes in, so this is European, this is DAX again, cash session comes in, breaks the high, relentless bid. This is on a 5 minute chart, and it's straight line. Every single 5 minute candle breaks the high of the previous. Continues, what we call a one time framing move. And what this then does as well, and this illustrates the idea of correlation, that the drive up creates a gap in the US markets, because by the time the S&P cash session opens, the correlation from the S&P overnight session to what happens in Europe drags that up, creates a gap in the S&P, and then that does the same thing. Open, liquidation gap up, and this then drags the European equities, their next leg, towards the upside, giving you this very impressive drive higher, which in fact closes the gap. Once you get into the gap, there's nothing there. Remember that. There's no trade in here. No one's done anything. The market's just gapped down through there. Of course, there was previous trade prior to this gapping back down, but there's very little on the recent move. And so this is an area that can move back up reasonably quickly and reasonably cleanly. So it's not just a case of the gap initiating move, but also look at the gap that's created and the ability of the market to then move through that. And that's what's happening in this phase just here. Right, island reversals. Again, think about what's happened. This is sort of a continuation of a initiation gap followed then by a liquidation gap. So it's kind of the two things brought together. But what's happened? You get a directional move down and then you get a gap down. This is strong. This is a good sign that the move's going to keep on going. As such, we can be confident this is going to keep going, and people are going to look to sell as long as we are below this previous low. Brilliant. So this generates a bit of selling pressure, generates positioning to the downside, and it's now a bit of a wait and see as this positioning gets built up. You see volumes go up in this range as well. That's a further indication that there is more action going on, more participation, more sign that this can keep on going. But with an island reversal, and what's really important about this is the significance, because this traps a huge number of people. It's less about the kind of inference that, oh, well, you know, there's some people trapped, there's some people not. Anybody who has sold in here and accumulated a short position in here is offside. There's no doubt, there's no sort of, well, they might be offside if it goes through here and through here. They're all offside. If you've sold in here, you're offside if it gaps up. As a result, this then gives a very strong sign to buyers. The buyers have been able to overwhelm sellers against their own gap. Yeah, they've got the selling gap and sellers coming in, and buyers have still overwhelmed them. They've still defeated them. This is a great sign for a move up, and then is what spurs more buying to come in. It traps all the sellers, which also add to the buying. Why are you going to sell now if the market's gapping up against you? You've just had a very, very clear message. This market doesn't want to go down. If buyers are able to not just prevent the market falling, but also create a gap up, show enough strength and enough willingness to pay higher prices in the opposite direction, that's a very strong sign. That's what then creates this move back towards the upside. So that's the general idea. And you can then see this followed on by a breakaway gap, further breakaway gap, which fills, and then we get the exhaustion gap, gap up, reverse straight off the open, and then move back, gap fill before continuation up. So that's the idea and the rough sort of structure of an island reversal. Again, you're only really likely to get these nowadays on cash sessions. You will very occasionally get something like this over a weekend, where you can end up going into a weekend with one piece of news, and then that news story changes over the weekend and creates the counter gap the other way. It's pretty rare, because the fact that that whole story has to develop, and so you end up with kind of a week-long island reversal that you gap into a weekend to create the gap up, so that you have enough time over a weekend to gap for the news story to come through, followed then by a week, and then the next weekend, the coincidence that the counter news comes the following weekend as well. So they're quite rare to actually get on a full session chart. Generally more a cash session thing, but cash sessions where all the volume is. So you do get situations where you can have a full session gap, but you have to look at this in a kind of reality terms of, this isn't a perfect island reversal, but it's the structure that matters. It's the understanding of what's going on. So what you've got here then, full session, gap up, gap down. It gaps down still within the range, so it's not a full gap, but it's enough of a gap to highlight that this candle on its own has been left. And yes, some people won't be offside who've bought towards the lows of this candle here, but enough people are going to be offside to allow for this move back down. And the visual of it is enough for people to then have conviction that this is a move down, or the potential beginning of, because you've got the island reversal. You then get the move back down through the previous range, sweep through the range, nice quick move down, then you get the gap breakaway type move, and that's this move here. This creates a gap down from these couple of days, which then is sufficient to bring enough sellers in to get through the most recent lows as well. So that's your sort of full session island reversal. What I have a look at here is two types of island reversal. That you can have an island reversal that is technically not perfect. And from a textbook point of view, this island reversal here, the one as I'd call island reversal in range, is not an island reversal, because it is not at the extreme of a move. Now there's always kind of an element of, well, where exactly is the extreme of the move here? Because you could argue that this isn't either, because of that you have a low down here. This is an example in oil. But the way I'm looking at this is, that's the most recent low, that's the most recent high, so this isn't a break out of the range. Whereas here, so in terms of describing whether a market is at an extreme, this move here has broken the most recent low. As such, I would deem this to be moving to an extreme. And that would be the distinction between this being an island reversal at an extreme, below the previous swing, and this being an island reversal in the range. Now, both of these are going to have a tradable short-term impact, and then it's about the follow-on that is significant in terms of the daily idea of an island reversal. You can only get an island reversal on a daily or a weekly time frame, because within a day, markets are so liquid now, you will not get gaps within candles. You're not going to get a gap on a 5-minute candlestick, because markets are so liquid, they'll continue trading through every sort of turn of a 5-minute period. If you do get a gap, it's going to be one tick, because the market's trading at the extreme of that candle, and then the next trade immediately is the price above as the new candle ticks. But that is going to be it. So there is a distinction between the two, and the distinction being, so there is a distinction between the two. And what you're going to be looking for is that this gap up produces a more limited reversal pattern because you are just essentially trading within a range. Whereas this gap up provides the opportunity for a much more directional move, which is exactly what happens. Once you get above the previous swing, now you can start looking at this as a more clear bias type trade, whereas this is more of a short-term opportunity. If you recognize it, you see the challenge, you can take the trade on. That's the way that you need to think about this. And so this is what we end up with. This is the first example. This is the inside range island reversal. And what I'm looking for here then is you get the gap up. This is on the cash session, remember, so the main oil session. Gap up, first move fills the previous gap. So the island reversal is done. This first kind of insight into a profile I bring, just because it becomes a bit easier to see on a profile. This is the trade that you're looking for. There's the open. The first move then is to fill the gap. And so you can play this initially from the open and buy it to go and fill the gap, or you can wait for it to get inside this range and look for it to then trade up the range on the day. So on the day, your bias is very clearly to the upside. But after that, direction becomes a little bit more murky because this is still essentially within a range. And as such, you're not expecting this to suddenly put in a much larger move. If it does, as in if this starts a larger move, then you can consider it. But that becomes a secondary trade. This is not enough of an indication. This is not enough of an indication to suggest that that must happen. This is an indication of a short-term opportunity that once you get inside the previous range, you can then look for a drive up and this sort of change in sentiment in the short term. Whereas you take this one to the one that actually gaps through the low, and this is a 2-day island, not that the number of days massively makes a difference, it's about what's happening and the trapping of positioning. In this one, you're going to be able to play this in a slightly different format. There's your gap, all the way up at 65.05. And here we open, flick down, so open, dip, back up. As long as you're back above the open, now you've got a defined stop below the low of the test down. And if you wanted to, looking for a profile, this makes it a bit easier to see. There's your open. There's the previous gap. So you could look at that and say, right, you could buy the open, stop inside the previous range because that would invalidate the island reversal, and then play for the move up. That's the classic technical way of playing it. That you buy the open the next day, your stop goes back inside the island or back on the island, and you expect the complete counter trend move. If you played it like that from here, you're taking on a 35 tick risk, and you get paid very, very quickly on the day, nearly 200, and you can then look for this to be the end of the move down, end of the drop, and then the move back up. Incidentally, from here, oil actually then moved to $85, so 62 to 85, a full sort of $23 move from this point. So that's the significance of seeing the island reversal, whether it is at an extreme or whether it's not. Too often, I think the rules around these things of, oh, it's not an island reversal because it's not at an extreme, prevent people from taking the opportunity that is still there. There is still an opportunity on the other one because there are still trap positions. Whether this leads to a much larger directional move is much more up for debate, but don't dismiss the opportunity that's there in the short term, and even the bigger perspective one. In the short term, that's your first opportunity. That's what you're playing today. After that, then you can think about additional opportunities. The next day, you get another gap up. Now you can start to play this. Similar principle, open, dip, no fill of the gap, through the open, play to the upside. So you get this clear understanding or picture as to how you're going to play these trades. That's what you're after with this type of structure. That's what you're after with these island reversals. It's about thinking about how exactly you play these types of trades. And just to complete the kind of understanding of this, this is what it looks like when you have it on a full session. So this is this gap up. Now, what's going to happen? Because this is a cash session gap, you will have got trade that's moved us up here. And this is where it's great because now you have a market that is open, that trades up here in the out of cash session hours. So you can see the island reversal developing already. You can position and play this earlier. That once you get up here, up above that 63.75 area, you can start playing this to the upside with the idea that you will be on an island reversal by the time that the open comes. So if we're going to have a little look at this, this is what's happening. There's your 63.75. At this point, there's the island reversal. So now the island reversal's on. So you could be looking at this and trying to buy on, say, a pullback towards 75. You can find an entry above here, that this will give you a situation where you're long into an island reversal. And if the island reversal starts to play as you would expect, you're then going to get driven onside very quickly. And so because you now have this overnight session, the understanding of where you are, where you've moved overnight relative to the main cash session, and that highlighting of things like an island reversal provides so much opportunity. A chance to be long into it, a chance to play the break here that comes, and this is again where you can then structure your trade a bit more. This is the beginning of the cash session. We open just inside this little range with the island reversal. So you don't even have to buy the open and put your stop down here. You can play the breakout and enter there. It's always, like I said, about giving yourself options. The situation dictates those options to you. You don't know where the opportunity is necessarily going to be. You know the basic tenets of the opportunity, which is buy the open, put your stop here. But there may well be a more optimal way of playing it. In this instance, there is. You can play the break of the overnight session. Alternatively, you could pre-play it and you could buy once the island reversal is beginning to be created and try and buy essentially within the gap. So by the time the open comes, you've now got yourself in a situation where maybe you've got a very tight stop and you're already on side, ready for this open. So that's the way you need to be thinking about these island reversals. Particularly nowadays with so much overnight trade or sort of out of main cash session hours, gives you a situation where you get a move that can happen, that can get you to a point where the break's coming and allow you into the trade before that island reversal structure is actually fully in play. So a chance to sort of preempt and pre-position for a move. Next up then, ranges. And yeah, the simple way that everyone trades a range, you just buy the bottom of the range, you sell the top of the range. Dead easy, this is the perfect trading conditions. That's easy to say. The problem is, in reality, that's not the case. Ranges don't move up and down in a beautiful, sideways, even, balanced way. Of course they don't, because as time goes by, perspectives change. People get themselves into positions. Now, once people are in positions, they may well be influenced by market movement as to whether to stay in or get out of positions. So the reality is not something like this. The other tough reality with trading a range is by the time you've established that this is a range-bound market, typically then it's built up the energy, the positioning to no longer be range-bound. And this is also the other difficult part of a range-bound market. Now, when we get into profile, you'll be able to see situations where a range-bound day can be very predictable. And so in that scenario, yes, a range simple strategy of buy the low, sell the high works very well. But in the sort of short term, often ranges are more a case of a slowing down of action, a building up of energy, a kind of sort of rest phase for a market before a next leg of movement. And that's the bit that we need to be considerate of. So the reality is, it's nice and easy to say, the reality is when you get to the top of the range here, as the range is establishing, realistically, you're looking at this thinking, okay, there's a level, maybe we get a pullback, maybe you take a bit of profit. You may well buy the bottom of the range here. But of course, if you're buying the pullback, chances are you're expecting the break. So in no way are you, in many situations, actually selling it here, cutting and reversing. And actually, more likely, you then become frustrated when the market comes back to you. So again, you may well buy down here, or as many people do, and this is part of where a trading a range is difficult, and my point that people get influenced by their positions, many people will actually then scratch. So they become a seller at the bottom of the range. Some people will sell the top, but the longer it goes on, your conviction that this is actually going to hold generally will turn more to an expectation that it's going to break. So the sequence of how a range develops often doesn't result in the simplicity of being able to trade a range, because by the time you've got enough information to suggest it's a range, what you've also done is weakened the top and the bottom of the range sufficiently for a break to occur. So really what you need to be thinking about, unless you're going into an area with the expectation of range-bound trade immediately, it's an easier way of looking at a range actually as something that can be played out of. And so you're looking then for a change in the way the market's trading. You're looking for some kind of order flow shift that comes in here or on the break here. That's what you're after. And as you see that, then you've got a directional cue. You've got that sense that, right, people in this range have now taken the rest that the market requires or established value. There's an evening out of people's perspective of where value is. And then that perspective changes, and that's what drives things out of a range. The reality is as well, for many ranges, you will get ranges within ranges. We talked about this in support resistance, where you'll get this kind of pivot in the middle of a range, as opposed to just simply one range that trades up, down, up, down, up, down. And so what this means as well for the reality of trading from one side to another is that you may well sell the top of the range here, looking for it to trade all the way down to the bottom of the range. But the reality is, you may get stuck multiple times trading the top part of the range before eventually falling down, which may end up being too late in the day for you to be able to profit from. You know, you can end up with a situation where time pushes you out of a trade. And by the end of the day, let's say, for example, you're trading here, leaving you in a situation where you have sat in a trade for a significant amount of time, only to be maybe 2-3 ticks on side. And this is frustrating. I'd be inclined, and whenever I see this type of scenario, particularly like I say, profile will highlight this very well for you. When you see this type of scenario, what you've got to think about, to establish a range, you need people willing to sell as the market rises, people willing to buy as the market falls. Now, what's going to happen is as you reach the extremes, you run out of counter trade, i.e. you run out of buyers towards the top, you run out of sellers towards the bottom. As such, the market's going to gravitate towards the center, meaning that the majority of trade is going to take place in the middle of the range. As such, any play from the edge of the range back to the middle is more optimal than trying to play from one side to the other, because people's perspectives change as the day goes on. Clearly, in this scenario here, what's happened is actually buyers have concluded that they're going to struggle to get filled at lower prices. Therefore, they move their bids up, and this is what prevents the market from falling. Sellers are still comfortable to sell down to the middle, and so you then end up with this range establishing higher. So often it's a case of once you establish that range, playing to the middle multiple times is a more optimal strategy than trying to play from one side completely to the other. Now, what we're going to try and focus on here is more looking at, because we'll come on to trading a range and the predictable nature of ranges, but more looking at how a range can be used in terms of actually executing trade directionally. So the sort of less common strategy, or what is generally conceived as less common, buying the highs and selling the lows of a range, playing for the break. So what you have is the two ways that ranges break, essentially. You either have a break from inside the range out, or you have a break from outside in and through, both of which require an order flow shift. They require a pickup in pace. They require some kind of change. Now, the change doesn't have to be dramatic, it can be subtle, but as long as you're seeing a change in the way the market trades when the top of the range is reached, this is an indication that actually a break is more likely than a hold. And therefore, you can then try and play out of the range. Typically, this change in flow, this change in pace, is more likely to come from somewhere in the middle of the range. It's not often that a market's going to rotate to the top and then suddenly pick up information or pick up pace to get out. Often the clue comes from within the range. Now, this is something that needs to be observed from an order flow perspective, rather than simply an assumption that you could buy in the middle of the range or sell in the middle of the range and look for the break. That is by inference, a 50-50 trade. If you decide, right, I'm going to buy the middle of the range because I think we're going to break to the upside, you've got just as much chance that it's going to break to the downside. So yes, you do have a defined stop beyond the extreme of the range, but your edge is going to get eaten up by the fact that you're going to get caught out and stopped out as many times as you win on the trade. So yes, you may make more money on the winners, but that's going to be eaten up by losses as well. And so it becomes more just a kind of guesswork and a game of guess and then try and apply a big enough target to justify the guess, which is not an optimal strategy. What you want to be doing is waiting, if you're trying to play the break of the range, for something that indicates the direction of the break. Take something like this and we'll move it over here. The first bit of information you get, you start seeing a pickup in volume. You start seeing the pace coming from within a smaller range inside the wider range. And as that happens, this is then what gives you the clue that allows you to then buy on the break of the range. This is something we'll look at with order flow of what happens on this candle, because that's the candle that tells you the move is on. It's not about all of these candles. It's not about what happens in here. It's about this candle. This candle says to you the move is on now and you can play for it. That's the information you're looking for the range break. Otherwise, you're sitting in a day that is reasonably unclear on what exactly it wants to do. It's all about the flow. It's all about a shift in either information or perspective. Either of them will do it. You get new information and people act on that, which creates flow. Or you get a change of perspective. Somebody within that range, in this instance a buyer, concludes that they're not going to be able to buy as much as they need to by continually putting bids in this range here. As such, they change the way that they execute. They decide they're going to come to market, they start to buy. They buy through the offers, through the offers, through the offers, and that's what drives the market out of the range. So that's one way. The next version of a range break is the back in and through the range, and what I call a catapult. And for those who've looked at a kind of Wyckoff strategy, this is a sort of simplified version of it. And I think a lot of Wyckoff theory is often simplified and regurgitated as simple theory rather than the sort of full context of the whole theory behind this types of movement that he proposes. But one of the key concepts is this catapult idea. Now, the reasoning that he gives compared to the kind of thought process that I go through is slightly different. But the essence is that once you have a failure of direction, a failure to break one way, this provides information. Now, who's creating this move and why this move is created, I think, is trying to assign cause to effect. And I don't think that's necessarily worth doing. You're never going to be able to know who's created this move and why they did it. So I personally have the view that you don't need to. Leave that alone, it doesn't matter. What matters is that the information you've gained here is we have had sufficient buyers to get away from this range, but we've not got sufficient buyers to maintain the move away from the range. The implication there is that these early buyers in here are now essentially stuck. And sellers who are looking to play the move back down or play the market short have now been given the information that buyers aren't strong enough, that they can now be fought back on. So while sellers in this phase are going to be stepping out of the way and thinking, okay, we'll sell higher and higher and higher because buyers are continually rushing towards us, now they're getting information that buyers aren't still coming in. And so as they fall back into range, all the buyers who felt that they were right in this area are no longer right. They become sellers. Sellers become emboldened because they've been shown already that buyers don't have the strength to keep the move going, and buyers also can't fight back when the move goes back to the range. As such, you're looking then for a sweep through the range. So there are two different ways that a range can break. There's either the break from inside to out, which requires order flow change and requires you to notice the change in action within the range before the break, or there's the break from outside in. A market that's away from a range can use a previous range as an area to accelerate through. Reason being, anybody long in this range has now been proved wrong. They don't want to be in this trade anymore. Anybody wanting to sell has now been shown that buyers can't maintain this move. I'll give you a further example. This is one in the T-note. Simple, sideways range, market trades very stable, stagnant range sideways. This is pretty tight. This is a range of around about 15 full prices. So not much in T-note, half a point. Trade up and down this for a few days. So you're looking for the potential of a move out of this range. And we get it. You do get a little bit of a pickup in volume. And we're going to come on to volume shortly. Little pickup in volume, market breaks the range. No continuation. This is a clue. Now, of course, until you're back inside the range, this could well be a pullback and we're going to keep going. So you can't make the conclusion that this is a failed move down until it fails, until you get back inside the range. But what you can infer is that with the move back inside the range, there's very little to get in the way of a move straight the way through, because you have this sort of dual reason to buy. If you're short, you've been proved wrong, you need to get out before you go offside. If you've been selling from up here, you've got the width of the range to get out of that still in profit. Otherwise, you run the risk that it breaks the top, because this is clearly a weakened level already. You've also got the sellers down here, which provide extra ammo because they're going offside straight away. They've got to take their loss. And on top of that, you've got buyers who now have been shown that sellers can't keep it going, and buyers who perhaps have been pushed out of their trade here now can get back in and try and play this one back through the range, knowing that you're likely to have much less resistance to this move this time than you are whilst you're trading in the range here. So it's about the implication of a certain move away from range and what that says to you about the next leg towards range. And this applies to older ranges. It doesn't just have to apply to a range that has been created today or yesterday, or a range that you are trading immediately. The ones that I've looked at so far are ranges that have just failed, that have literally broken, spent maybe 15 minutes outside, or maybe spent 2 hours outside, back in and back through. But any range suggests that the market is traded here. We don't need to hold there on the way back again. And there's essentially 2 points to hold. Think about this from a buyer's point of view. When the market gets back to the top of this range, that's where buyers gained control. They created the break, market moves higher, channels higher. So that's where buyers are in control. So from a buyer's perspective, where do you want to buy this? Well, at the point where buyers had the greatest influence on the market, top of the range. Now, you go back below there, the next point that buyers had the greatest influence was the bottom of the range, where they prevented the market from falling any further. As such, buyers have 2 points to buy, here and here, leaving very little reason for them to buy anywhere in the middle of the range. And that's part of why the market's going to drop, because you're going to get buyers who either buy at the top, and if it doesn't hold, they're going to exit, and they're exiting to sell to who? You're not going to get many buyers buying it here, because they're all now thinking, right, well, if it can't hold the top of the range, let's see if it goes to the bottom. You do get this kind of pivot zone in the middle, which can produce an element of support. As you can see in here, we do hold around that level, which is 1889. Do hold around it, the market stalls. But on the whole, you're looking for a move through. Now, in terms of the move through, the way I describe this is that it's a smooth move. Now, smooth doesn't necessarily have to mean fast. And what I mean by smooth, and the more that you get into this, and the more that we spend time looking at order flow and things like that, you need to have your own kind of description of things, your own way of describing something so that you know what you mean. Now, what I mean by a smooth move is a move that doesn't present a great deal of pullback. It's steady. Once you're onside, you don't get put under any pressure. Doesn't mean that it's going to go instantly to target, but it's not going to come back on you. That's what I'm looking for, because as you fall into a range, that expectation that buyers are just going to melt away until the bottom suggests that you're not going to run into a great deal of buyers, meaning that there's not going to be a great deal of resistance to the drop. As such, looking for this smooth move through. And this plays out in two ways. We go and look at this gold one. So that's this move here. You've got a range here of around about 300 ticks. To the middle of the range, you've got around about 150 ticks. Now, the move through the range comes in one go. This is a 1 minute chart, and the move comes instantly. The entire range is taken out. There is pressure in the market here. There is sort of trade down, and then the acceleration becomes panic. You get huge volume of movement and this immediate surge. The entire range gets taken out in 1 minute, just shy of 300 ticks. Now, that's not super common. And what you've got to do is going into a range sweep like this, you've got to go into it with this expectation, this could happen. This is viable. And so the way you play it, whether it flies through or moves through nice and smooth, is the same. Your sort of requirement to get into the trade comes early. You need to get in at the top of the range, because if you don't and it does this, there's no way in afterwards. So the necessity to enter the trade comes here. There's no ability to add on to this. Sweep down, and then after that you get this balancing effect, and the market will then stabilize within that range. Alternatively, it can sweep down through the range and then continue. The pace of this precludes that it will not be able to do that, because the move is so quick. You're not going to find enough sellers that are willing to come in 300 ticks later, 1 minute later. So that's a very smooth move. You don't get any pressure if you sell that. You go straight onside, you fly onside. But an alternative version is this. And we'll look at this in terms of the specifics of the execution when we get into order flow, because the way that you execute these two different trades is very different. The sort of skill set, recognition of entry differs. So what we've got here is what I call a steady sweep. Again, very little pressure. This is a move through a previous range. And there's not a great deal of pressure on you. You buy it, re-entering the range. This again is on a 1 minute time frame. Market sweeps up through. It's steady. It does take a lot longer to put the move in though. It's a smaller move. This is around about 90 ticks as opposed to 300. And it's a smaller, steadier move. But never are you put under a great deal of pressure. So you've got to differentiate the way it moves, but the expectation is the same. Each time you're going to see this reasonably smooth movement. Therefore, you can look at it, get yourself in, and you're going to expect to not have to be under any great deal of pressure and watch your market move through to the top of the range as a minimum target. Once you escape the top of the range though, that then acts as a new area of support. This is where you can shift your stop up to back inside the range and then play for a continuation as well. And you can use these in a short-term basis. What we've looked at so far is using a range to sweep through. So the trade itself is the move through the range. You can also use them as an opportunity to continue a move or to catch up a move. Now, this is an example that came on the back of a piece of news, and this was the news that Tesla is going to invest a portion of their spare cash in cryptocurrencies, alternative assets, gold. As a result, Bitcoin on the left, gold on the right, both rally. But what happens is that as Bitcoin continues, gold consolidates. So this continuation of movement higher in Bitcoin, gold consolidates and then falls back. So effectively, Bitcoin has gone further than gold here. And you've got the potential then for a catch-up play in gold. What you can do then is use this mini range as an opportunity to play for a continuation move. So what you're doing is, once the market comes into the range, you're using that as an area to execute. You can buy in this zone, expecting that once the market breaks away from there, now you've got the catch-up move. Now you've got the continued move higher in gold to keep up with the distance that Bitcoin's got. So you're using correlation, but you're then looking at that correlation and saying to yourself, okay, how can I get into this? Well, the way that you can get into this is by buying as you re-enter this zone. You re-enter the zone, you buy, and that's then what drives the market higher, keeps that move drifting onwards. So that's how you can use it on a short term. And we'll look more and more at this with order flow, finding these little execution zones and how you then manage your positioning and manage your trade within those zones. We'll touch on it a little bit in entry and exit as we go through later on this week. Right then, last couple of bits in terms of patterns. And I know a lot of patterns that we've looked at are considered reversal nature patterns. And with so many patterns, I think they're often sectioned out very easily or very quickly into reversal or continuation or breakout. But each pattern can be played as a breakout or as a reversal, dependent upon how you like to trade it. So take, for example, a block reversal, as I would call it. This is typically a reversal of a generalized move. So essentially a market that goes like this and back up. But it doesn't mean that you can't play this as a breakout type trade. Likewise, a grind reversal, and I'll explain these in a little bit more detail in a moment, can also be seen the same. That you can play this as a kind of continuation type move back through a previous grind, rather than just purely seeing it as a reversal trade. So the generalized direction is, yes, a reversal. And many patterns do indicate this sort of change of events, if you will. But ultimately, they can be played as a breakout or a continuation or a reversal, however you wish to kind of view that trade. So, onwards. Block reversals then. What a block reversal is essentially a market that just runs out of energy. Market that gets to a point where, using a kind of rectangle idea, a sort of sideways trade, uncertainty, essentially, this erodes the market's ability to keep going. What really you're looking for here is a kind of continuation pattern. You'd be looking for, after a drop, a flag to keep the move going. But people will still position for this. People will start to position selling for a second wave in here. And what happens then is they get themselves positioned. They're looking for this next leg down, but what happens is volumes die off, energy falls out of the market. And when you start seeing this, and a market then that doesn't create this continuation, you don't get the pullback and next leg down. Instead, you get a pullback, reaches the low, this is the chance for the drop, and it doesn't happen. So now you've got disappointed shorts. You've got the shorts in from here, you've got the new shorts in from here, and they're all getting more and more and more disappointed. As a result then, you have the opportunity of a mini liquidation. These shorts get out, followed then by a larger liquidation as buyers become more emboldened. Not only have they seen an inability of sellers down here, they've also been shown that sellers are willing to give this up with this little liquidation out. And so what you're then looking for is this steady movement back up. As people steadily come in willing to buy now, and also shorts who are in this move that are progressively getting closer and closer to their stops, or closer and closer to their average price, start to exit steadily. You can get an extra little clue on a move like this. Something like that, a little failure to the downside. An indication that, given the chance to go lower, and this is the way I always think about this, given the chance to go lower, nobody has come in and sold it. It's what I call a should trade. The market should go down when this low breaks. And when that doesn't happen, this creates disappointment. This also creates a sense that this is a market that can now go up, because given the chance to go down, it's not taking it. Now it can rally. So you break the range. Once you're out of the range, you can use the top of that range, like we talked about with previous range-bound trade. New buyers are going to enter here, and then you're looking for a reversal type move. Typically, this is a very steady move. It's not a sort of ultra fast move, because with a reversal type move, you still have people thinking that this could be a sell as the market steadily rotates back up. As a slight variation on this, you then have the kind of reversal of this, or the mirror image of this, where you have this grind move followed by a sweep. So what I call a grind sweep. What happens is this move down is a move down that comes without a great deal of pullback. So whilst I've drawn it as a market with multiple pullbacks in it, these pullbacks are very, very minor, creating essentially a very sort of straight move down, sort of slow and steady drift. It could be a drift up. What happens then, and the reason why you can have this sweep, is that it's very difficult to define where a reference point is to sell within a move like this, or where a stop can be placed. As such, there is no incentive to sell as the market bounces, because why are any of these points going to be viewed as any stronger than any other? They're all very minor pullbacks. Ideally, and what you're looking for on a sort of move that does provide you resistances on the way back, is a move that moves down, has a noticeable pullback, and you can clearly say moves in phases. You'd be able to say, right, there's the first leg down, followed by pullback, followed by next leg down. Very clear. Whereas in a grind move, you don't get that. In a grind move, all you get is this just relentless drift down. So we'll come on to that in just a moment. First up, I want to touch on a block reversal trade. Now, this essentially is a pattern that lacks continuation. So what happens then is you get directional move down. Note here, volumes drop off. Even in here, after the volumes have gone up and we move down into this zone, volumes very quickly drop off in here. This indicates a lack of participation, a lack of willingness to go lower. You don't get a continuation pattern formed. You get this just sideways range. Same here. You get a little dip down, but there's no continuation pattern. There's no sign as to why this would go, or where people could enter the trade. So the only point that people try and enter is on a break of the low. And this then requires more selling to come in. But if that doesn't happen, very quickly, there's your clue. There's your information that this could now be the time that we're going to reverse. It doesn't have to immediately initiate the reversal though, but it's a clue that's now saying to you, the break to the upside is perhaps now more likely, and it's something you want to be looking for. Take here, for example, the inability to go lower actually happens before the range forms. And then the range forms at a higher price than this first dip down. Whereas in the DAX example on the right, you start to form a range, then touch down, no continuation, and then very quick rip through the range. I talked about previously options on a trade. How do you get into this trade? And this is a prime example. There's two ways to play it. One, you play it for the quick liquidation, the shorts who've got in down here, getting out. And then you can play for the new entrant buyers coming in. So it's less about people getting out now. These people are going to be the first ones getting out, the sort of little spike out the range. But once those people are out, what you're looking for is new buyers. Now, buyers don't rush to get in. They're going to try and get the best prices. As such, you often see a pullback. You won't see buyers chasing this. Instead, they're going to step back and try and put their bids in and get filled at as low prices as they can, typically using the top of the range as support. So you've got two ways to play it. There's the breakout way of playing it, and then there's the passive entry reversal way of playing it, where you buy the pullback and play towards the upside here and here. Both of which then instigate a reasonably steady, smooth move, typically back to where the drop came from, like that. That's what you're looking for. So you've got a clearly defined target, you've got a clearly defined stop. The stop can be done in two ways. You can either place your stop back inside the range or below the bottom of the range. Obviously, below the bottom gives you a greater chance of not getting stopped out. Putting it just inside the range increases the chance of being stopped out, but does result in a smaller cost if you're wrong. It's a difficult one to argue because if you fall into the range, the possibility of a sweep through becomes realistic, and I'll give you an example of this in a moment. As such, stopping out just here inside the range perhaps actually doesn't give you that many more stop outs, because if you get to here, chances of going to here start to increase quite dramatically. So essentially, your chance of being wrong here isn't much higher than it is here. i.e. if you get there, you're probably going to there. So you might as well have a tighter stop. Take less cost if the trade goes wrong. Right then, as we talked about with some of the other patterns previously, it's the nuance that matters. It's about the general structure of the pattern, not just the pattern itself. So this is going to look at a slightly more nuanced block reversal in the S&P. This is a decent sell-off type move. You get this very steady, and this comes from that head and shoulders that we looked at previous. Now, that head and shoulders, the break back through the payroll's high, drop down, is a nice trade. But on its own, you're looking for perhaps a move down to here or perhaps a move down to here. And that will be about all you're after. This does not imply that a move like this is coming. But once a move like this happens, you've now got the potential of an additional trade or a different type of trade. So it's then just moving through the action as it comes. Yeah, it's very, very choppy drop. Market has one further move down and a bit of an exhaustion down here, and then we get the reverse. So we're going to go and have a little look at the specifics of that reversal. So this is the reversal here, back up through the range. So what you end up with is this similar kind of structure. And you can kind of see this block in two ways. You can either see it as a small block down here, where we drop through the previous day's low and then find support with one dip lower. As such, that becomes your first break of a mini block. Alternately, you then have the entirety of this overnight session. So this is outside the cash hours. That is essentially a block down here. And as such, the break on the open, on the cash open, is your liquidation of everybody who's been selling down here looking for a continuation. So it's not about the specifics of it needs to draw a perfect little rectangle at a low, break, pull back and go. That's your textbook trade. But the concept of what that's showing you, that it's a market that is running out of energy, unable to keep the move going. That's the bit you're after. That's the bit that says, yeah, the reversal's on. And you can then have that confidence to play against what you're expecting to be a liquidation of shorts from this move, shorts from this move. As they get forced out, buyers get shown that this is a move that has run out of energy and is now a situation where they can buy with confidence, that you've run the sellers out. You don't have any more sellers. I'll touch on this very briefly. Concept of a symmetrical reversal. And this is more about targeting. So it's not about a structure that necessarily implies a symmetrical reversal. But a target on a trade is often back to where the move came from. So back to the origin of the first move. Take this one, which is a block reversal trade. And this is my point, that if you have your stop just inside the block, once you get in, this is used then for a sweep down. This is one in cable. Drop down to the block, sweep through, you would get stopped out very quickly, whether you had a stop here or here, both of them are going to get hit. And so the touching the first stop pretty much implies that the second stop may well be hit. But in terms of target, this move down, this liquidation move down becomes your target. And you get this symmetrical move. Often, the way we go back is very similar to the way we go down, particularly when the move down is fast. Because what's happening is if the move down is fast, everyone rushes to sell. As such, you don't get a great deal of people selling on the way back, because like a range, there's either the sellers taking control here or sellers maintaining control here. So you end up with this kind of vacuum action where sellers either sell here to retain control, or they wait for the point where they were last in control back at the top of that reversal. And that's why you get this symmetrical type move. I'll give you another example of this. This is a head and shoulders pattern, but the break move, the break of the neckline and the move down goes straight back to the same origin. This, in fact, actually coincided and correlated almost perfectly with the S&P one that we looked at. Same time frame, same situation. Head and shoulders pattern, whips down, very, very similar drop to what you get on the original move up. The original move up being the non-farm payrolls low, same kind of move here. There's your breakdown. We break through the low within the head and shoulders, and this is what happens. You get this little bit of tricky trade here. You get the break down, and as it hits 32, which is the low of the right shoulder, you get this little bit of stall. This is the moment where if there's a bounce to be had, this is it. This is where it should be coming from. It doesn't happen, and then you get this reasonably clean drop, pull back, drop phase of the move. The way you've got to think about these types of trades is once the move starts, once you get the drop down, you've then got to look and say, right, as long as we're below 32, this move is going to keep going, and I've got a target symmetrical down to 17. That's the bit that you're after, and that gives you this very clean move straight the way down. We do get, again, then this kind of little block trade or switch trade. Forms a block, liquidation, pullback. The top of the block then provides you with your support, and then you get the reversal. Where does it go back to? Test of that neckline, but it's the symmetry in the drop. It's a very similar type of drop to the move up. Similar size movement as well. That's what you're looking for. It provides a very clear target. The origin of the move is often a very, very good target. So think about that symmetry as you're taking trades on, particularly when you're trying to define a target for yourself. Okay, quick example of a grind sweep. This is one in the pound. This is when we're much higher volatility movements in the pound. This is a move five points up, followed by pretty much 5 points back down. But it's this phase here, this 3-day grind. And this is what I mean by there's no notable pullback in this. sort of any consolidation phase, the phase where you look for a pullback for the market to slow down, you're getting these steady movements higher rather than one more typical sort of pullback. It's just this steady movement higher, and then you don't get a great deal of change in the way the market trades. It's just relentless bid up. That straight away indicates to you a market that is struggling in terms of being able to sustain itself. Because what you're getting is people constantly having to pay higher prices. It's a bit like that kind of ascending or descending wedge structure, where people get themselves trapped one direction or another, and once they then get pressured, they all have to run for the exit because there's no obvious place to place a stop. So people end up placing their stop rather than in a sensible point technically where the market's unlikely to get through. They place their stop at an arbitrary, generally profit-related point. So as their profit starts to fall, they either get out before it falls to a level that they deem it unacceptable, or they get out as they get back to a scratch or as they go slightly offside, because there's no other way of defining risk. As such, you can end up with this sweep type move down because of the fact that there's very little to stop this. Essentially, you just get this constant flow of people exit, meaning that you get, again, this reasonably smooth move towards the downside. And this is a move where volatility is very high. And so you do then get this very clean, very fast move back down. But this, again, can be something that builds over multiple days, weeks. This is even nearly an entire month. We spend the entirety of 1 month trading in a sideways range. You can see each little dotted square is a week. So you've got 4 weeks of trading completely sideways here on the back of this week-long grind higher. As such, when you move into this zone, there's no obvious place to stop. So as a result, you get this very smooth drop through. You look over here, the way we go up in that grind phase that takes the best part of 3 to 4 days, it's reversed in 3 to 4 hours because people have to get out. People who have been buying and holding on, all of a sudden start looking over their shoulder as we fall into this range and start thinking, there's no obvious place for a stop here. And those selling know that there's nothing to stop you selling. Why would you stop selling until you get down to sort of this area here where we did actually have at least some kind of resistance before a breakout? This is where the move really starts from. And that's where we then start to drift down through. Now, of course, you can't say that every time you're going to get all the way down to the most recent reference point. You do have a weekly high just here, and we have formed, and that does complete the week just there. So you can see why it stopped there, but you have to look at that and start thinking, if you're on this move down, and this is about expectations, if you're on this move down, you can look at that and say to yourself, well, unless I'm shown a reason to get out, a reversal pattern, I'm going to be reasonably confident that this can keep on dropping. There's not a great deal that's going to get in my way, and that's the way that you've got to think about a move like this. Final thing we're going to go and have a little look at then is a V exhaustion or a V reversal trade. This, I think, is one of those trades where people find it very easy to look at a V reversal and say, oh, look at that, it's a brilliant trade. You get in, you fly on side, it's wonderful. The hard bit is, where do you buy? That's the biggest problem, because in hindsight, these look great. You get a fast move down, a fast move back, brilliant. You buy at the low of the move, you're going to get this wonderful trade that goes straight on side, and you give yourself a nice big target. The problem is, as it's dropping, you don't know where the low is. So you can buy and go offside, and there's nothing to suggest or to tell you how far offside you're going to go. In some situations, catching the falling knife, as you would call it, you may well buy at the low of the move. But in other situations, you could end up buying it and watching it drop another 200, 300, 400 ticks, and you're still thinking, well, it could be a V reversal. Chances are you're right, but how far it goes also indicates that chances are you'll get into a situation where it's almost gone too far to be able to come back, or it's not going to come back fast enough for you to still be confident with this trade. So what you've then got to start to look at is the reality of what happens and the phases of a move. And this can happen in an instant. This can happen in a matter of, say, 5 to 10 seconds. And this is where order flow comes in, because you cannot see that on a chart. But what is actually happening is you get a very short pause at the low. This has to happen. Market drops, and you have to, at some point, run out of sellers. With a V reverse, you get this instant run out of sellers. Market drops, no more sellers, buyers can then come in, and buyers then have to chase because there are no more sellers. Yeah, there are no more sellers here, and then as it starts to bounce back, no more sellers are going to come in because the market's now starting to bounce back against them. They're all sitting there going, right, let's put our offers up here and wait. What then happens is you get to a point where you do find some sellers, where buyers no longer rush to buy the dip, and the market settles. Now again, this can be very, very momentary. This could be 10 seconds. this could be something that lasts 10, 15 minutes. So really for your V reverse, rather than trying to buy the bottom down here, which is the lovely Hollywood trade, it looks great and you can say, I bought the low. Instead, what you want is structure. You want a way of being able to say, I can buy it now, because after this is the point now where the kind of battle happens. Sellers are going to sell to keep the move going, or buyers are going to become emboldened. They're going to see that this is the exhaustion, there are no more sellers, and now the market can bounce back. So it's the escape of this zone, and essentially a mini flag for a continuation trade within the reversal that allows you to then play back to the origin of the move. So that's the reality. We'll go and have a little look now at what exactly happens. So this is what you could call, and the thing with a V reversal is the sort of visualization of it, if you will, is that it's very, very fast. Now, this is something that occurs over an hourly time frame. But if you weren't sure of the time frame here, you would look at that and go, V reverse, perfect. But you have a long, long, long time to get in. There's 2 hours at the low down here before the bounce. But you then get the drop, the basing part of the trade, and then the reversal entry. It's about sort of seeing the phases of this. But as this base is here, this is the point where you can then start to say, okay, now I know what I'm after. Now I can try and buy this. Now I can structure a trade, either to buy the bottom of this range or to buy the breakout of the range. Either way is a viable trade. And the whole point behind it is you've now seen the straight line down that has run out of the ability to keep on going. And the only way anything changes is if you find enough sellers who are now going to re-enter and sell for a second leg, creating a pullback. Something similar to this. So you get the drop, pullback, drop. In this case, bigger time frame, drop, pullback, continuation. And this is why, again, as I mentioned before, a pullback is not a pullback until you get the next leg down. Equally, a reversal is not a reversal until you get the next leg up. At this point here, it could be either. The fact that you've run the sellers out, and this is potentially a V, allows you to look at it and say, right, I'm willing to try and play this to the upside. But you have to accept there are going to be scenarios where you're going to be wrong on this. And if it does go for a second leg, you also have to be willing to try and play the continuation to the downside. It's about decisions before you get to the point of execution. What I'm going to do is have a look at two variations of a V reversal or an exhaustion. And this happens over a couple of different days. This is in the euro. One, a straight exhaustion move, and then the second, perhaps what you would call a more V reversal. But both of them act in a very similar way. What I've got here is a 5-minute chart of each. Now, with the exhaustion move, this comes very, very fast. Look at the volume on this 5-minute candle. You're trading around about 13,000 contracts. With the V reverse move, or the kind of symmetrical bounce move, what ends up happening is you trade around about 6,000 contracts. Now, with each move, what you get is this very fast phase. This is your instant exhaustion. This is essentially people getting forced out of positions. And as soon as that's happened, you've run out of sellers. Look, the volume drops almost instantly back down. Then you get the bounce and this small sort of basing pattern before the break up, retest and continuation. But it's the overall sort of phase, drop, bounce, base, continuation. That's the bit that you're after. With the V reverse, a much trickier scenario. Because with the V reverse here, you end up with a situation where the drop is very fast and you get this 5-minute candle that essentially sort of creates an uncertainty element and then straight line back up. Makes for a much tougher trade, in fact, than the much faster exhaustion base reverse. This one, it's about noticing the change in the action, the slowing down in here to be able to play it actually out of this range. Now, if we take this onto a 1 minute, it does become a little bit clearer. That previous one is now a 5 minute, so drop, base, up, and seemingly on a 5 minute, just V reverse. So what happens on a 1 minute? This is the very fast exhaustion move. This is the V reverse move. And that basing situation doesn't always have to happen above the low as it does here. With a very fast exhaustion move, you would expect that you get this very quick spike back up as people who have been selling this now chase to get out. And then you get the stabilization. Whereas here, the move slows down. You then get the battle at the low. So this is the point where the market's going to either roll over again or start to reverse. Once you break away from here, this is where you can then look for this steady move straight the way back, symmetrical reverse. So it's about understanding the phase, the fast down, consolidation, basing, essentially the sort of two-directional battle, and then the break up, and then the reverse up towards the what you would call scene of crime, where the move originated from. So that's what you need to be thinking about with any kind of V reversal type trade. It's the phases of the action. Quick summary then. There's really a couple of salient points here. But what a pattern does for you is it gives you a structure, gives you a framework to work within. Now this doesn't mean that you have to take every trade on precisely the same. It doesn't mean you have to trade every setup and every structure that is available to you. You need to be looking for the ones that make the most sense within the wider context. What they do give you is an ability to clearly define your entry. You know exactly where you should be getting in and what should happen. You can define your risk as well. And whenever you're taking a trade on, make sure that you've considered both the amount of risk you're taking. Whenever you're taking a trade on, make sure that you consider both the amount of risk you're taking and what you're likely to get out of it. Patterns will provide targets, which can help therefore in sort of defining your risk reward. That way you can define whether this is a trade you are willing to actually take. Be very aware though, that just because you've got a pattern that suggests a market to go up, there may be that this is happening within a wider pattern. So just remember that every pattern is a pattern within another pattern. And so therefore you've got to look for the situations, the best situation is the situation where one pattern plays into another. So you get this dual effect of sort of one pushes onto the next, that drives the larger directional move. The other thing that you want to be considering is positioning. And this is what a pattern helps you do. It helps you understand the balance of buyers and sellers. So ask yourself, and one of the easy things to do is just sit down, look at a pattern and say, okay, what are buyers doing in here? Have buyers built positions? And are they now under pressure? Where would they add to these? Where would they get out? And the same for sellers. That way you can start to understand the nature of the escape from that area. What happens as the pattern develops, as you move. That's going to give you a huge amount of conviction in what you can see happening and allows you then to not just understand what's going to happen in terms of where you're going to move from and to, but how you're going to do it. And I think the most important thing with any kind of pattern is understanding how. It's not just where, but how exactly that's going to happen. Also, and finally, give yourself options. Patterns won't work first time every time. Doesn't mean the pattern has invalidated itself. So a pattern that doesn't work doesn't mean that it can't work. So take, for example, that head and shoulders structure that we've looked at, where you get a drop, bounce, you buy it on the break here, market goes up, falls back in, you get stopped out. It doesn't mean this is invalidated, and you can then still get that reversal type structure. So be willing then to perhaps play this as a breakout trade there. Maybe, yes, you take it with less size, but make sure that it's the pattern that's invalidated, not your trade as a loss, as to the reason why this situation still can't resolve in the way that you may have thought it could. So give yourself options, understand where you can enter the trade, where the fast part of the move comes from, where the slow part of the move comes from. Take, for example, that kind of block reverse where you sit sideways like this. There's two ways to take this. You can take this trade as a break here and play that as a little quick break, or you can play it there. Either trade's fine. There's two options to your trade. Make sure, and there's even a third, that you buy this as a breakout trade. So you're giving yourself multiple options within that trade. It's about understanding the structure of the pattern, less about the precision and the precise, you must enter here with a stop here and a target here. It's about being able to say, right, this suggests this type of movement, and therefore I'm going to play for that in a way that suits my style and my willingness to execute and take risk in this scenario. I'll wrap that one out there, guys. We're going to bring in indicators and look at volume and delta as well to enhance your understanding of a pattern. This enhances your understanding of positioning and your ability to then act on that.